So there are two main trading strategies that I use, styles. Everybody uses them, but it's vital and it's key to understand this type of strategy or the type of trade you're looking to put on before you get yourself in the market and before you click the buy and sell button on your keyboard. Each strategy or type of trade, it must be treated differently than the other in order to have success, and this is going to build consistency in our trading. It's a mistake I see a lot of traders make. They treat every single trade the same, regardless of strategy, regardless of style, and they try to make each setup basically like a one-size-fits-all, and it just doesn't work out like that. So I'm going to explain the two strategies that everybody uses, including myself, how to trade each strategy, bend the rules a little bit in order to find success. I'm going to break down the charts, and I'm going to show you some real trades I've taken and how to understand this in order to take better trading setups where the odds are in our favor to win. Before we get into the video, I'm going to post a link in the description below to follow me on Instagram at Investortrade. This is my only account. I definitely recommend following me. I post daily trading recaps on here along with very good trading tips and tricks that I guarantee you're not going to find anywhere else. The link will be in the description below, and you're seriously missing out if you're not following it. But now let's get right into the charts. As I said earlier, before you enter any single trade, you must know the type of trade you're looking to put on. I review a bunch of members' trades in the Investor Trade community, and one of the most common mistakes that I see with traders is they don't know the setup they're looking to enter, and because of this, they treat every single trade they take the same, when finding success in the markets is being able to adjust and bend according to the setup that we see in front of us, because not every single trade will be the same. What I mean by this is the first trade is a scalp. This is obvious. Everybody knows what a scalp is, but these are shorter term price movements. These are quick intraday moves, fast entries, and even faster exits. So I'm going to pull up the S&P 500 here right now. I'm going to explain the difference between the two and how to trade each setup. But just for those that don't know what a scalp is I'm looking to capitalize on a quick little intraday move. A setup that I took today was actually taking long the S&P 500. You can trade SPY options off this chart. Right down here at 3986. It was a great entry. I actually bottom ticked this by one tick. I sold this position at 4,000 before the market made its bigger move, but this was a quick little 14-point scalp. I wasn't looking to hold this for a long time. I was looking to get a fast entry and an even faster exit when my target hit. That's a scalp. I'm not looking to capitalize on such a larger move. The second one is a trend trade or a day trade, and this is holding for a bullish or bearish trend. Is the market making lower lows? Is the market making lower highs? Is it making higher highs, higher lows? This is longer than a scalp, as you are capitalizing on a larger ranged move because you are capitalizing on a trend in the market where obvious bulls or bears are winning the intermediate term trend that you could capitalize on a larger move. So we could go to let's go to a hourly chart, and a trend, intraday is a day like this where we have a very large sell-off by about 180, 160 points, where the clear and obvious trend is putting in lower lows, putting in lower highs, and the market is downtrending severely with all red candles. This is a trend trade to a severe edge, but even a simple trend trade, I'll go to a 5-minute chart, is a day like the day prior where, we had a sell-off. Let's just say we got short up here near the highs, and maybe our target was demand down here at 3970. We're looking to capitalize on a larger move over a larger span of time. So these are the pretty much basis to every single trade. Everybody's watching this. If you're a swing trader, this doesn't really apply too much to you. It will a little bit. But for a day trader, we're either scalping or we're trend trading, capitalizing on a larger move. With this in mind, there are 5 major points that I want to go over where we differentiate the two. Now, this goes back to understanding, knowing the setup that we're looking to enter before we put it on. So before you put a trade on, know if you are scalping or know if you are trend trading. This is going to help you to understand which one you're going to take and how to adjust and react accordingly. But it's vital to understand. I'm looking to enter, let's just say, let's pull up Tesla here. Okay, I'm looking to enter Tesla down here at 289 demand in this area right here, and my target is 299 or 298. I'm looking to trend trade this trade before I put it on. Or, okay, Tesla's coming off this demand zone. I'm going to scalp this, and I'm going to hold it only into VWAP, or I'm only going to hold it into high a day. That's a scalp, and you must understand what you're doing before you enter the trade. If you go into the market not knowing the setup you're looking to enter, then you're going to struggle because you are not reacting and adjusting your conditions and adjusting the trade according to what the market's giving you. So how to differentiate the two? The most important thing to understand the difference is market conditions. You must understand market context and market conditions. What I mean by this, and a good way to look at it, we're going to first start, and I recommend doing this, is just going to a higher time frame chart. Look at the overall bigger picture trend. In examples like this where the market, this is a daily chart on the S&P 500, where the market was uptrending, right? We were putting in higher highs, putting in higher lows. Every single dip kept getting bought up. What I mean by this is the market dipped down, we got bought up, we dipped, bought up, right? We're putting in higher highs and we're also putting in higher lows. When the market is uptrending like this and we have a clear, obvious trend on a higher time frame chart, then trend trading will be easier to achieve. And we can look to trend trade more than scalp. But it all depends on your edge and your style and your strategy. These are conditions where it's easier and a higher odd to trend trade. Versus, I'm just going to go to a smaller time frame chart now. I'm going to go to, let's just say, a 30-minute chart. Whereas the market, when it is balanced, in this example right here, we're moving in a very tight range, back and forth, where the highs get sold into and the lows get bought into, this would be more acceptable to look to scalp instead of trend trading. Now, Carmine, why is that? Well, when the market is balanced and we're consolidating in a tight range, we have buyers and sellers agreeing on price. Essentially, what this means, I'm even going to go to a 5-minute chart, and you could look at this on a smaller time frame chart, larger time frame chart. It depends on the type of trader you are. What I explain on a smaller time frame chart will apply to a higher time frame. And that's the beauty to this, because this works in any market, any stock, any future, any crypto. It doesn't really matter. The price and volume strategy or analysis works with any market because every market is an auction place. So what I explain on smaller time frame applies for higher time frame. When the market is balanced like this, right, where we're in a very tight little range, I'll try to highlight this, right? Highs are getting sold into, lows are getting bought into. The market is balanced. Buyers and sellers are agreeing on price. When we have an equilibrium between buyers and sellers, the supply to demand equation is in equilibrium, it's equal, and we're not going to have one large size participant making the market move in a single direction with a trend continuation. With that being said, when the market is balanced and in a tight range, it is easier and a higher odd to scalp the market, fast entries, faster exits, because we can capitalize on shorter term price frame movements when the market is balanced and consolidating in a different range. A mistake that I see traders make, and I could even go back to, any day. For example, in this case right here, the market's balanced in a very tight range. There's really no true area other than the overnight session that we could have capitalized on a 50-point rally. Other than that, the market was very flat. It's almost like a heartbeat where we're just consolidating, moving up, moving sideways, and we're just not finding a clear direction. That's fine. That's healthy in the market, but you must react and you must adjust your trades accordingly. A common mistake that I see is a lot of traders try to trend trade a market when we are in balance and the market is balancing out and in equilibrium. What I mean by this is a trader might get long, let's just say up here. They see the market's balanced, they get long right here, and they anticipate the market to rally 50 points to the upside, not realizing the market is in a very balanced state. For the market to be imbalanced, meaning buyers are outweighing sellers or sellers are outweighing buyers, that's when we get a supplier demand imbalance, and that's when we get an disequilibrium, or one side of the equation basically outweighing the other, and that's when we're going to get the big move, and that's when we're going to get the trend trading type of scenarios. In this case right here, the obvious equation was sellers were outweighing buyers, the market began to sell off with heavy volume, and we continue to move lower. This would be better to capitalize on a larger time frame move, where you can capitalize on a trend where the market made a larger ranged move. So conditions are very key. This kind of also blends in with volume. When there's volatility and the market has momentum and large volume in the market, that's when we're going to get larger moves. Not only is it good for scalping quick moves, because if you're trading options are also priced off of volatility. But when there is volatility, when there is volume, when there is momentum, this is when we're going to get large price swings in the market, and we could capitalize on a larger move. Whereas when volume's dead, a lot of people get frustrated, right? They expect, okay, volume's dead, I'm going to try to trend trade something. For example, a day like today, right? A day like today, volume was completely dead, and some traders were trying to trend trade this move, right? And capitalize on a larger move when volume was dead. But play around with it now that you understand conditions, and that's going to bring me into my next point, which is time frames. Time frames are important because if we're looking to trend trade something, right, we're looking to hold for a bigger move, we might have more noise on a smaller time frame chart. Whereas if we're scalping something, if we go too high of a time frame, we might miss the move, or it might cause us to have a late entry. So time frames are very important. You must understand the time frame trade you're looking to put on in order to enter that trading setup. What I mean here is, let me just adjust myself. Here's a trade I took on the S&P. This is August 31st, Wednesday. The market sold off, and I traded the S&P 500 long off of this little 3986 level. Like I said earlier, I bottom ticked this area. Now, to be honest with you, I was not watching a candlestick chart at all, especially when I'm scalping primarily the S&P 500. I would say maybe 80-90% of my trades have candlestick analysis involved in it. However, most of the time I am watching the time and sales and level 2 to kind of tell me when to get in that setup whenever I see buyers or sellers on the tape. You could also use a tool like Bookmap, which is actually what I used to enter the setup today. So the market sold off into this level, and I took the market long right at 9:35 when the market sold off like this as we were coming down, because I did spot buyers. Now, because I wasn't watching a time frame chart and I was watching the tape, I spotted something that I may not have seen on a candlestick chart. Because at this point, if you're looking at this, nothing really signifies that the market is going to bounce at this level. But on the tape, you would have noticed a passive buyer and more aggressive buying out of this level. But let's just say we don't use the tape at all and we do use a candlestick chart. Maybe we get valid confirmation when we start to see very heavy selling pressure off of this level. The market starts coming up. We get in long right here at 937, which is still a good entry. Our stop loss is below the low. So right now we're risking about 6 points, and maybe our target is the high, which is about 14 points away. So a little over 2-to-1 risk to reward. Pretty good. So now the market, we're in this trade, let's just say right here, the market comes up, maybe it struggles at 4,000, we take our profits fast, or the market blows past it and we sell at the high a day for a quick little 14, 15 point gain, and we just capitalized on a quick little scalp in the market using a 1-minute chart, or not even using a chart, right? This is scalping. However, if we came into the market with a trend trading mentality, and let's just say we used a 5-minute chart, right? So now I'm going to go to that same setup, and it's going to look a little bit differently. So now I'm on a 5-minute chart, and at this point, the market came down. Maybe we hit demand. Maybe we saw buying pressure out of this. And let's just say we get long at 4,000. Now, our risk to reward is going to be a little more skewed because our entry is now at 4,000, a little bit higher. And maybe our target, I don't know, hypothetically speaking, is the high of pre-market in this area right here. So now we're at 4,000. Our risk is 3,986. Now at this point, we're risking 14 points to make only 16 points. Not a good risk to reward at all, and I would avoid this setup. However, the mistake that I see is a lot of traders don't know if they're scalping, or they don't know if they're trend trading, and they get into the market, let's just say on a 5-minute chart, way too late, skewing their risk to reward. This is a setup I wouldn't even take on a 5-minute chart. They get in, maybe it doesn't hit target, maybe it does, and they don't sell, the market comes down, and they stop out of that position just because they entered on the wrong time frame and they did not adjust their trade according to the setup that they are looking to take. Another example of this would be a trend trading setup. So let me go to, let's go here. And this was the sell-off from last Friday. This is August 26th on the S&P 500. We rejected these two supply zones pretty well. And let's just say with this in mind and with the volatility that we saw in the market, it was a clear and obvious trend to the downside at the point that we did sell off intraday. That's another point I want to make, actually. The two differentiate the 2 points. Not only do we have conditions on a larger time frame scale, but we also have conditions on an intraday basis. Those two are key. And when both conditions line up on a higher time frame to smaller time frame, that's going to give us a clear and crisp picture on the trade that we're looking to open up. Everything that I'm explaining, I want you all to test out, try out for yourself. It's not something that you could fully understand without being, in the middle of battle and getting things thrown at you and reacting and adjusting according to that. So this is going to give you a good roadmap. So conditions intraday, conditions higher time frame, and time frame charts that you were looking to enter. Now, what I mean by this is, let's just say we got short when we hit supply and the market started coming down. I don't know. Let's just say we got short right here when the market looked like this. We were breaking the low and we're short at the yellow oval, right? Now, if we're on a 5-minute chart, we're expecting a larger move out of this. Let's just say we have demand, I don't know, in this area right here. So let's just say there's demand right there. We're short over here, and we expect the market to sell off about 70 points into this demand zone. Now, if we're on a 5-minute chart and we're getting short right here, this is a clear and obvious trend. We're putting in lower lows. We're putting in lower highs. Volume is very key. As you can see, volume is very, very high. When volume is high, that shows there is interest and participation in the market. When there's an increasing amount of participation, this is when we get large price swings and can capitalize on a trend trading move. Before I look to enter any setup, I always look for high volume before and after my entry, because that shows more participants are interested in trading that move. So now I'm in short, 5-minute chart, lower lows, lower highs. We hit target, and that could have been a stress-free trade if we were on a 5-minute chart. Now, if I go to, let's just say, a 1-minute chart, bear with me as I find this day, August 26th, I think it was. Now, let's just say I go to a 1-minute chart, right? And I'm short over here at the oval. I see the market sell off. We come over here, and we start consolidating. Now, I'm going to start freaking out. I see the market come up. Maybe I stop out of this trade because I'm on a 1-minute chart, and I have a scalping mentality, although this should be a trend trade, right? And I see the market come up. I see green candles, I freak out, and I exit this trade prematurely because I was on a wrong time frame chart, and I did not see the bigger picture was still making lower lows and still making lower highs. In fact, a trade that I took yesterday, and I could actually pull this up in the Discord because this was not a good setup at all that I took. It was a losing trade, but perfect example of this. So I took a losing trade on August 30th. This is a day before that you're watching this video, and I looked to take the market long at a demand zone. Now, I was on a 1-minute chart on this setup, and I failed to find any buyers. So not only is the time frame going to help us enter a trade, it might help us avoid taking a setup that we shouldn't be taking. So go into the S&P 500 again, and I'm just explaining it on the S&P because it's the easiest for me to do. This works on any Tesla, Amazon, Apple, Microsoft. It doesn't really matter. But basically, the S&P had demand in this area right here. And I was on a 1-minute chart, and I got long on the first sign of green. I saw green in the market, and I got long, speculating that we were going to come up. Wrong decision, and I was on a 1-minute chart, not realizing that buyers were not involved. However, if I went to a higher time frame chart, let's just say a 5-minute chart, I would have saw now it looks completely different. There's absolutely no signs of buying at this level, and I would have avoided the setup if I focused on a higher time frame chart and maybe had a trend trading mentality, because the market was moving in a larger price increment, 50 points from the high. So that's the time frame. That is very vital. And then point number 3, targets and stop losses. Key here. Key. And this depends on the conditions. This depends on the time frame. And this is why I put it number 3, because everything that we're going over, it's like a pyramid. Conditions are at the top, time frames are below it, stop loss and targets are below it, and the 2 next points are going to be below that as well. So target and stop losses are in the middle because you need to know the time frame you're on and you need to know the conditions you're trading in. Going back to the setup today, just what I said earlier, remember? So on a 5-minute chart, if I was expecting this to be a trend trade and I was expecting the market to bounce off of this level right here, if I'm entering right here, let me move myself again, sorry. If I'm entering right here at the upper oval, target and stop loss, remember. If I'm entering right here at the oval, my target, let's just say, is pre-market highs, and my stop loss is the low. My risk to reward ratio based off of this setup is not valid. I will avoid the setup. However, if we're on a 1-minute chart and we're scalping this, now my entry is down here. This trade, I was risking about 3 points to make about 14 points to the upside at 4,000. I should have really targeted the high a day. But everything looks better in hindsight. This would have been definitely a little bit of a better target. But I sold right at 4,000 and I maintained the risk to reward ratio. With scalping, we need to have tighter stop losses and tighter targets. Remember the definition I explained earlier about we're getting short-term price movements, quick intraday moves, fast entries, and even faster exits? If we are scalping, this is key, tight stop losses and tight targets. You want to ensure yourself that if you are wrong, you're going to protect yourself. And if the market makes a move for a quick scalp with increased volatility, we're capitalizing and we're taking profits off the table to make it a stress-free trade with a quick movement. It's all about repeating that process over and over. However, if we are trend trading a setup, and I'll pull up Tesla over here to make it, a little bit differently. If we are trend trading a setup, you could have further targets, which a further target will enable you to have a further stop loss. When you are scalping, you want to make sure the scalp works out pretty much immediately. That's how pretty much all my scalp works. If you are trend trading, you need to let the trade have room to breathe. A lot of traders have too tight of stop losses on trend trades, and they stop out of the position before it begins to work out in their favor. If you are trend trading, make sure you have a wider stop loss and you could have a further out target. Let's just say I want to get long Tesla down here at this demand zone. It starts coming up and I'm holding this for a trend trade. Maybe the market, maybe the S&P 500 is trending that day and everything is lining up to be an imbalanced day where the market's going to make a big move. So now I'm in long, let's just say up here. My stop loss could be the low. So yeah, I'm risking maybe 3 or 4 points to make a potential 11, 12 points to the upside if I'm targeting, let's just say 299. These are all hypothetical scenarios. Each target and stop loss is going to be dependent on the structure in the market and where the market could potentially reverse and where our analysis is going to be incorrect. But the main point I'm trying to make here is if we are scalping, our targets have to be closer and our stop losses could be tighter. And if we are trend trading, our targets could be further out and our stop losses could be wider in order to make the trade have room to breathe. This also now bleeds into position size, because if we are trend trading, we can have smaller size in the market because we are capitalizing on a larger move. If we are scalping, I recommend going with larger position size because you are capitalizing on a shorter move. And the more size you have on a shorter move, let's just say 5 contracts and you make a quick dollar, a quick 10 points, that's might be better scalping versus trying to get 50 points on one contract. It really depends on how you trade. But if you're scalping, you could go with larger position size. And if you were trend trading, you could go with smaller position size because we are going to have wider stop losses. I do not want anybody to go into the market tomorrow or the next day and expect to scalp after watching this video, expecting to be a millionaire and expecting to master the market. And now they go full port. They enter their full count size because they heard me go larger size on scalping, and they blow up their account on one trade. This is only if you have an edge, and this is only if you have something that you tested that works out for you. So position size is different for the two types of setups, and then managing the trade. This is key. So I have like a little saying, and I've said this in one of my other videos, is I could make a scalp turn into a trend trade, but if I make a trend trade turn into a scalp, that means I did not manage the trade accordingly. Or there's some exceptions where maybe I expected a trend to happen, but a red flag appeared in the market and it's less likely a trend to happen and I get out of the trade prematurely. But I could turn a scalp into a trend trade if I manage that trade correctly. What I mean by that is, I don't know, let's just, again, speaking, let's just say I got short, or let's just say I got long again on the S&P 500 off this level, and I have an intention to scalp. This is the setup that I took today. And instead of selling my full position at 4,000, right, I have a scalping mentality. I'm looking to capitalize on a fast move. Instead of selling my full 100% position at 4,000, maybe I'll sell 90% of it, or 75% of it, or 50% of it at 4,000, my target. And if conditions are now leaning towards a trend, maybe volatility is coming into the market, maybe we're starting to become imbalanced, maybe demand or supply is forming, I could turn this scalp by selling a portion of it. I could turn it into a trend trade now. I see the market continue to move up, and let's just say we rallied another 10, 20, 30 points off of that. I could just turn this scalp into a trend trade. I'll just go to a higher time frame chart, maybe a 5-minute, and then I'll just focus on the trend. You know, in this example, it didn't work out, but maybe we continue to rally another 30 points off of this, putting in higher highs, putting in higher lows, and I just made a scalp turn into a trend trade. Same thing with the day prior. You know, let's just say I had intentions of scalping, let's just say a low a day break. So let's just say I wanted to maybe short below this demand zone. I got in short, maybe targeting, you know, an area right here. So quick little scalp. Short right here, targeting this level. I'm in short now on a 1-minute chart. We don't really react to this level. I see us continue to sell off. Now I'm okay. The market's far away from my entry. I'm managing my risk. Let me get out 75% of the position here and let me capitalize on a bigger move. I'll now go to a 5-minute chart, and now I just manage the scalp. I managed to turn it into a trend trade, and I could have capitalized on a further sell-off to the downside. So there's many ways to get creative with it. There's no right way to do it, but there is a wrong way to do it. So I know this was a longer video, but understand the type of trade that you're looking to put on. Are you scalping? Are you trend trading? And adjust and react accordingly. I don't have a set of rules saying, okay, if I'm on a 1-hour chart, I'm going to trade off a 15-minute chart. Or, okay, we're on a 1-minute chart, I'm going to scalp this. You know, there's no right way to do it. It's just what works for you the best. And I can only explain what works for me the best. And I hope I did that in this video. So if you enjoyed it, I would really, really appreciate a thumbs up on this video. Let's try to get 986 likes. Subscribe to the channel if you haven't already. I would really appreciate that. And definitely check out the links in the description below. My Instagram's on there and the Invest the Trade program is as well. But I'm ending it. Peace out.